All right. Good morning, everyone. So we're going to give it a few minutes. We have more people registered today than any of our previous webinars. So that's cool. Thank you, everyone, for registering. We're going to give people a few minutes just to get into the room. I guess one thing to let you know is there is a chat function on the far right. I am one of those odd presenters that do not mind if you write questions in there. And generally speaking, I can do the presentation and read your chats. I don't know why. I'm just an odd duck, I guess. So we'll give it one more minute. While we're waiting, just a word of advice. This is about taxes. I'm going to make it hopefully a little bit fun and interesting, but it's one of those things that with how much we have to go over today, if you start to get distracted, people are walking in, you got a bunch of windows open like I tend to do, you're going to probably get lost quickly. So I just ask you to shut off cell phones, close your door, whatever you need to do. So that way we're focused, we get something out of this, and we can work together through this. So today's webinar is titled How to Defuse the Ticking Tax Bomb That's Threatening Your Retirement. Now, as we go through here, one of the things I want to keep in mind, and I'll do my best to remind people, is that there's totally different planning when you're in your 30s or 40s, maybe even early 50s, than when you're in your 60s or 70s. Because when you're in your 60s or 70s, we're now making assumptions about what tax rates will be in maybe 5 or 10, 15 years. When I'm working with somebody, well, I don't work with a lot of people in their 30s, but maybe myself. When I'm working with my wife's 401k, we're talking about something that's 30 years in the future. So it's totally different. So looks like we've got quite most people that are registered in. So let's get started. As I said, just to get the most out of it, probably one of the best things to do, take some notes, be able to ask some questions. Love interaction. I really encourage that. Taxes isn't always one of the most fun things. Actually, the least fun thing about taxes is what? Paying them. But one of the cool things is being able to avoid them in a legal way, mind you. There's 44,000 pages of tax code. It drives me up a wall when people are like, so what's the gray area? Can we live there? No, we cannot. I'm not going to help you do that. I'm a kind of a black and white person. Now, just like anybody else, I want to avoid and minimize taxes as much as possible. Easy story to that was a few years ago, because I wear suits on things like this on TV, in appointments, I figured that I should be able to write them off. And so I went as far as I had two closets, and I put my business suits in one closet and my church suits in another. And I went to my CPA and said, here's all my, he had denied the expenses on like when he showed me the preliminary return. I said, whoa, wait a minute. I've even got them separated. I go, I could get audited. They could come up and I'd be like, here's the business clothes section. And over here, totally separate closets, here's the church section. And he gave me a couple different things. He's like, you can do it. By the way, you can do whatever you want, but it won't work. It's a gray area. You're right, but you're wrong. So I'm not, I don't like helping people live in a gray area. We've got so many black and white rules that we can follow. Let's use those. Let's be safe with it. Let's not lose sleep over it, but let's pay the least we can. Because in the end, if you give money to the government, which is called taxes, they'll spend it 5 times. It's just how they do it. So times have changed. I like to talk about your grandfather's retirement. Back then, I even look at my grandparents, because my mom was born. My grandparents had 3 kids, and then they were done. And then my I guess it would be my oldest uncle, passed away from polio before they even knew what it was. That's how early it was. And so they were done having kids. And then for a few years, as the story goes, Grandpa bought Grandma an appliance like every other month. And then Grandma kind of ignored the kids. And finally, the priest came over and he's like, Joe, you got to stop buying appliances. There's no more room for them. And he said, and you still got 2 more kids that rely on you. And then they had what I call the B team. And Grandma had 7 more. So my mom was 1 of 10, but my grandparents are actually a lot closer to a lot of my clients' parents' age. So when we look at your parents or grandpa's retirement, right? Retired with a pension, on average, maybe lived to 75, died at home, and worked. The first point I think is one of the most important. Worked at 1 company, maybe 2, probably 1. Now, what do we have? We got baby boomers, we got Gen Xers, and boy, who else do we got? We got the millennials. The millennials are messing all this up. The bullet points we'd have to have on for them, I don't even want to imagine. And by the way, it's self-deprecating because I'm at the early age of what is defined as millennials. So I love to make fun of millennials. It's very fun. Um, but when we look at baby boomers and Gen Xers, they've worked for multiple companies. Think of how many companies now. They're retiring with a 401k, 403b. Let's just call it employer-sponsored plans because they're, actually I can see it. I've got a number of clients on the call right now. And I know some of you had 457s as an example. So let's just call it employer-sponsored plans, or if I call it 401k, I just mean that's synonymous for everyone. Yes, millennials love avocado toast. And generally speaking, I love to make fun of millennials and say that they are absolutely wrong. I can't believe I'm admitting this right now, but I also like avocado toast. It's not too bad, especially with bacon. But I mean, if I had bacon to about anything, I enjoy it, obviously. Maybe I should stop eating bacon. I don't know. But the baby boomers, Gen Xers, you're living to 85, longer. I was having a meeting yesterday with somebody. There it wasn't yesterday, earlier in the week. We were talking about they were turning 70 and they were turning on their Social Security benefit. And they were talking about how, 8 years ago when we started working together, it felt so that 70 was going to be old. And somebody in the room on our team goes, yeah, 70 is not that old anymore. I go, no kidding. They're 70. No one thinks at the age that they're old. But, what we used to think is old is no longer old. It's going to continue to be that way with advancements in medicine. And unfortunately, statistically speaking, we know a lot of people, when you live into your late 80s, early 90s, likely you're going to pass away in a nursing home. Well, I don't know if statistically it's overwhelmingly likely, but it's becoming far more likely than it at least used to be. So let's compare the two. Grandfather, he could not live his money because he got Social Security, he got a pension. Really wasn't much need to invest. And further, because when I got in this business, CDs were paying 7%. It was easier. You paid off the house, you got the pension, and you put some money into CDs and you lived off the interest. Maybe not even all the interest. But things are different. And you really didn't worry too much about taxes either. And part of that's because of the way Social Security is taxed, which we'll get into. Today, you can outlive your money. A lot of people will. It's a huge fear. It's actually one of the number one fears, interestingly enough. It's critical to invest, or how you invest is critical. And we have to pay attention to taxes. Taxes, are probably as important as the rate of return. And a big piece here is that you've worked, a lot of you on here, you've worked for several different companies. So you're in the right place. If you're on this call right now, as many of you are, and you're wondering, am I in the right place? Number one, you're in the right place if you've worked for a few companies over your career. Number two, you have a pension, a 401k, money in addition to your emergency savings. You're worried about outliving your money. So a quick history of taxes. So interestingly enough, we talk about how expensive taxes are, but we're actually in a relatively low rate. We look back through the decades and we're talking about the highest marginal rates. That doesn't mean every dollar is taxed at that. You got to remember that taxes work this way. My first dollars are taxed at X. My next dollars are taxed a little higher. My next dollars, these different chunks are taxed in stages. So if you remember when Mitt Romney ran for president a few years ago, almost a few decades ago now, but he said he paid 20% tax rate. He was talking about his effective tax rate, not marginal. Effective says, hey, I made $1 million and 200 went out to taxes. That's your effective tax rate. Taxes divided by income. His marginal rate would have been that 39.6. So marginal rates always higher than effective rates. When we look historically, interesting, the red line is the highest marginal rate. The blue line is the lowest marginal rate. And you can see for many years, the difference, the gap, the margin between these was quite large. And that margin's been getting squeezed. And this is what's interesting about statistics and charts, math. Some people will tell you this is why taxes are too low and they're unfair to the wealthy. A couple of issues there, though. Who do we define as wealthy? If you remember when Elizabeth Warren was running for president, and this isn't a slight against Democrats because I've heard Republicans say the same thing, but one of her main pieces was that the average American could not afford a $400 medical emergency, and that wasn't right. I want you to think right now, do you have an HSA account? Do you know anyone that's got an HSA account? Think about this. If the average American cannot afford a $400 medical emergency or medical payment, unexpected cost, and you have an HSA account with $401, are you wealthy? If your friend's got an HSA with $401.03, is he or she wealthy? Maybe not. But here's the thing. If the average American cannot afford a $400 emergency, medical emergency, unexpected cost, and you can, you're not average. And the moment you're not average, you're either above average or below average. And if you got $401 in that HSA, you, my friend, are above average. And if you're above average, you must be wealthy. And if you're wealthy, we better tax you. So we got to be careful. We got to pay attention to this. Another interesting thing with taxes, and one of the reasons I think it's been going lower over the years. So it's rational how they're saying, yes, we should all, hopefully everyone on here is above average, but understand, is above average wealthy. And that's what one of the things that I think is eroding the middle class is it's often the government says you're above average. And the moment you're above average, you're wealthy. And the moment you're wealthy, we should tax you more. And once we tax you more, you don't have as much. And then we say, hey, what happened to the middle class? Well, you called them wealthy and taxed them more. One of the reasons I think that rates have been going down, though, is because think about it this way. How many people get upset if they say, we're going to give you a tax break? We're going to lower your taxes. That seems to be a pretty popular message as long as you believe it to be true. So, but even if there's tax breaks, it's hard for Congress to get together and actually pass that. Now, how many people like a tax increase? No one, except for Warren Buffett, who keeps saying he should pay more. But newsflash, Warren, you can write a check. You can actually, most people don't know this, you can actually just write a check to Social Security, the endowment fund. They'll take it. You don't get any more benefit. So there's no conflict of interest. Just write them a $10 million check and say, hey, you deserve it. You'll do good things with this money. But it's really hard to increase taxes, or people don't like it. So if it's hard to pass tax savings that people like, how much harder is it to pass tax increases that people don't like? The easier thing is to give hidden taxes, hidden ways to do it, which we're going to go over today. So if we look at how far, where does your dollar go? So you give the government a dollar, they tax it. You can see that 51% is going to what they call major entitlements. And pause if you're getting, actually I can see the attendees. My mom is not on this call, thankfully. My mom gets mad every time I call it entitlement program. And it's interesting to me that she gets upset about it. She goes, it's not an entitlement program. I think she might even say Mikey when she's doing that. And she's like, because I earned it. I'm like, that's what entitlement means. It was only maybe 15 years ago when we started giving every kid that plays soccer a trophy, that entitled became a negative connotation. Entitled's good. You're entitled. You paid into it. You earned it. So 51% is going to these entitlement programs. So think about that, though. Who gets these entitlement programs? Retirees generally, right? A little bit older. And so if our older population were to grow, well, if 51% is going to the demographic, the way things are today, then how much goes to it if that population grows? It's a big deal. Yes, I think that is exactly what happens. People associate the word entitled now with, that's why I don't know why. I think of kids playing soccer is spoiled. I know that's not true. It's just maybe how I grew up. They seem to be the most spoiled kids. I wasn't in soccer. I never wanted to be, but yeah, I don't know. It's funny how things we go through as kids or adolescents shape our beliefs going forward. So the last slide, I just said that 51% of our dollar, your tax dollar, goes to entitlement programs for a little bit older population, those over 65. Well, we can see right here in 2009, the U.S., now they're calling it senior population. 65 and older is what we're referring to here. 2009, 65 and older was about 40 million today. By 2030, so a few more years, it's going to be over 70 million. That's what it's projected to be. So it goes from 12% to 19, almost, not quite doubling. But think about that. If it's not quite doubling and it already took up 51%, how much more is it going to take up? So maybe you guys recognize Rick Perry. He ran for president a couple times there in the 2000s. And there was two things that kind of made him famous. One was during one of the debates, if you remember, he said he was going to slash programs. And he said, they asked him, the moderator said, well, what are you going to slash? He goes, I'm going to take away 3 programs. And he could only name 2. that he was going to get rid of to save money. That was kind of like the George Bush senior, and it's not senior, but first, right? Read my lips. That was kind of his moment. But he also did something. He called Social Security a Ponzi scheme. Oh boy, it's not. But there are some similarities. So before we get upset, just look at it. Charles Ponzi, it's actually named after a real person. Charles Ponzi decided that he had a better idea than investing his clients' money. Instead, he would just take the money, promise them high returns, and he would pay out those returns or distributions back to people using new money. So as long as he kept having new people give him new money, he could keep giving the old people the new money. And he could, of course, take some of it for himself. So it's really similar to a pyramid scheme. But eventually a Ponzi scheme, a pyramid scheme, they run out of new investors. Bernie Madoff, I'm surprised that we don't call it a Madoff scheme, right? One of the largest Ponzi schemes ever. But Rick Perry said Social Security is a Ponzi scheme, and he was kind of referring to this math. Again, I don't think that's a right comparison, but you'll see kind of why he used this language. Social Security started in 1935. At the time, there were 42 workers, 42 people putting in for everyone taking out. And so I always try to slow down when I say the put in phase and the takeout phase. I do a radio show with my wife, and we're on a number of channels here locally. And for about a year, I was calling it the put in phase and takeout phase. And eventually one day she stopped me, and it was kind of funny. I loved it. She goes, "Why are you talking about putting and takeout?" I'm like, "No, not putting and takeout, the put in phase and the takeout phase." So when Social Security started, we had 42 in the put in phase, and we had one in the takeout phase. And interestingly here, I love this fact. I don't think most people know this, is that the earliest age you could receive benefits back then was 65 years old, not 62. An average life expectancy for those in the put-in phase was 62. So most people wouldn't have, statistically weren't going to live long enough to collect. And those in the takeout phase, on average, collected for 2 years, 24 months. What's it look like today? We got 3 people in the put-in phase, only 1 in the takeout. Earliest age now is 62. It's actually 60 if you think about it, because if you're a widow or widower, you can take those benefits starting at age 60, and it's technically a different trust system. But you've also got Social Security disability. That can be really at any age. Average time, and then take it one more step too, is that if you're over 65, you can actually take a benefit for your kids if you have minor children. So most over 65 don't. But I've got a client who did. We took benefits off his thing for them. So they were collecting at like age 8, if you think about it. Average time to collect now is 23 years. That's why it's running out of money. So how does Social Security work? People put in, okay? There's really no giant fund. But that doesn't make it a Ponzi scheme. That doesn't make it. You remember when Chris Christie was running, when there was like 30 Republicans on stage, and I remember the guy, he slams his fist on the podium and he goes, "It's time we tell the American people that we stole." No, you didn't steal from it. Here was the thing with Social Security: where do you invest it? Do you keep it in cash? If you're 65 years old and you've been paying into Social Security for, I don't know, 45 years, would you be happy finding out it was cash? Probably not. So they bought government bonds. By the way, Canada's got a similar program. Guess what they invest in? Government bonds, some U.S. government bonds, the same government bonds we put in our Social Security program. But I digress. We've also got, this part comes kind of full circle here. We got David Walker. So he was part of, under, I think it was the Clinton administration, continued under the Bush administration. So we don't get a whole lot of, it was a 10-year term. We don't get a whole lot of nonpartisan anymore. But about as close as we could take here. What he talked about though was that entitlement programs are a fiscal cancer. And it's an unpopular conversation because you earned it. Let's not forget that you earned this. We talked about how Medicare is 5 times more costly than Social Security. He said his opinion was that tax rates need to double. Now, understand when he wrote this book, though, interest rates were higher. So as interest rates go lower, we can technically afford more debt. Think of it like a house. As interest rates go lower, you can afford a more expensive house. But interest rates might be increasing right now. So how does that affect things? And he predicted that our debt would continue to increase till it got to 53 trillion. We're right around 30 trillion today. So we got a little bit of runway there. But that doesn't mean, it's not a credit card. Sometimes people think this. I had a meeting yesterday and somebody was telling me, sharing a story with me about how somebody they knew had a credit card and they always thought, well, that's the amount I can spend. That's the amount maybe I should spend. It's there for the taking. That's not fiscal responsibility. So hopefully we get our debts under control a little bit. But here's the thing. Last year, I was reading an article not too long ago. I actually had to look it up this morning because I thought this statistic cannot be right, Mike. That cannot be what you remember. But last year was the highest on record, highest we've ever had of number of people not paying federal tax. Want to guess what it was? I can do a poll on this thing. I'm not going to try to do a poll. I'll mess it up. 61% of the U.S. population. 61% did not pay federal taxes last year. We spent more last year than we ever have in the history of our country. 98% of every dollar we've ever had in circulation has been printed since January 2020. That's why we're seeing some inflation right now. So, why do tax rates have to rise? Math. Okay, now let's pause there. I don't think we'll see a lot of direct increases. I think we're going to see indirect increases. And when we started this webinar, I cautioned you. I said, there's two phases of life. If I'm older in life, when I start talking about this, I'm not necessarily going to pay a bunch of extra tax right now, okay? Just so that it's taken care of. I might pay the same tax I'd pay anyway, or if I can lock in a 0 or a 10%, we'll talk about that. If I can lock in low tax rates, I'll do that. Am I going to convert all my money and be in the same tax bracket as Tom Brady? No, I'm not going to do that. I don't recommend my clients do that because we don't know what tax rates would be. If you're looking to leave money, as an example, I get this question all the time. I'm looking to leave money, and I want to make sure I don't want the government getting a bunch of it. Well, there's a couple ways to do it. Number one, you can buy life insurance. But it's interesting. When I start talking about life insurance and the money that people will pay for life insurance, it's tax-free to pay the taxes, so therefore the taxes don't exist. Oftentimes that's cheaper than paying the taxes today. But for some reason, it changes the perspective. They go, why would I spend money right now so my kids could have more? The second way is to create restricted payouts for your beneficiaries. Make sure that they don't take taxable accounts like IRAs, 401ks in lump sums. Make them take it out over 10 years. Restrict it. Create a trust. Get with your attorney. In my opinion, I'm biased here. Get a third-party trustee company to facilitate and administer it for the 10 years. By 2020, so that's in the past now. But David Walker was predicting, hasn't quite happened. So maybe it's not 2020, maybe it's 2030. But this is the trajectory we're on, where 90% of every income tax dollar is going to be spent on these entitlements. And again, that doesn't mean entitlements are bad. You earned it, you should get it. We can't take it away. We shouldn't, by no means. Nor do I think it would work. But we have to be cognizant of these things. So let's give you a case study. We'll call it Bill and Sandy Jones. Quickly though, this is just generic advice. This is not specific to anyone on this call. I'm not talking directly, this is the CYA portion, right? This isn't specific to you. This is specific to this case study. If you think that, this advice makes sense, give us a call. We can talk about it. Talk to your own advisor, talk to your CPA, but we're not giving you advice right now. So quick snapshot, Bill and Sandy, they've got 160 grand of income. They're 15 years away from retirement, 500 grand in the IRA, 100,000 bucks in savings. And savings is just liquid, right? It might be some mutual funds in there. They put 10,000 bucks into their 401k each year, and they have long-term care insurance and term life insurance. So a lot of advisors, they look at this and they're like, wow, they're doing really good. They're in good shape. Number one, when advisors get excited by what you have, I always caution people, why are they excited by what you have? Why are they so complimentary? Is it because you're in better financial shape than they are? Because one of the reasons they may be telling you you're doing really, really good is because they're really, really broke. Advisors oftentimes are. It's unfortunate. I've counseled a lot of them. But understand that. The other reason sometimes they're really complimentary is that you're more wealthy than their other clients. You're doing better than their other clients. You're an abnormality for them, which means their advice, it may give you good advice, but I think all of us don't do as good with something that we don't handle often. So I see a couple red flags in here. Okay. Let's go over those. The first thing we do, and a lot of times with how much we're trying to go over with our clients, we do a lot of behavioral finance in our firm. And behavioral finance is basically saying, number one, we got to teach you what biases are. Like one of them is called overconfidence. Okay. But I have to teach you what those things are first. Then we have to see which ones apply to you. And then we got to teach you how to overcome those things before we even talk about rate of return. But one of those, so we believe that, some of the most important things to do first is number one, teach people how to get more out of Social Security or their pensions. What's a better strategy? Number two, how to save in taxes. Because it's simple. Watch this. If we can get an extra dollar from Social Security, right? Imagine whatever you need in retirement is X, okay? If most of that comes from Social Security, you only need a little to make up a little bit. If half of it only comes from Social Security, you got to make up more. So for every dollar we increase your Social Security, that's $1 less that we got to rely on your retirement income or your retirement assets to generate for income. And as we don't have to rely on your assets to generate as much income, we can choose to take less risk. You don't have to, but you can choose to. And as you take less risk, the probability of success goes up. Sometimes people argue with me, but that's simple, right? Put 100,000 into a CD making 1%. I can tell you down to the penny what it will be in 5 years. That's easy. So as we take less risk, the probability for success goes up. Probability, the success of our projections goes up. Okay. Now watch with taxes. Here's what's cool. Every dollar you save on taxes is $1 less that we need your retirement assets to generate. As we don't need them to generate as much income, we can choose to take less risk. As we take less risk, the probability for the successful projections goes up. So one of the things we kind of do internally behind the scenes is we kind of break down our clients' assets. What's taxable now right here? What's going to be taxed later? And what's taxed never? You can't defer taxes forever. Actually, there's a little cheat there. You can sometimes. It's called a stepped up cost basis. So we do run into clients, and one of the things we'll do sometimes is maintain a more aggressive portfolio in an after-tax portfolio. Maybe they've got some individual stocks, and as those appreciate over time, based on current tax law, current tax code, the kids get what's called a stepped-up cost basis. It's tax-free. It's kind of cool. One of the big things that kind of comes out of the blue for people is the required minimum distribution. So that starts at 72 now. But sometimes people have to take out money, more money than they even want to take out. I've got a client that every month we've got to take out $25,000 every month from the retirement accounts. They don't need that much. They don't want that much. They didn't become clients until they were already 70. So this type of planning was kind of past its usefulness. We've still been able to do some things to minimize going forward, but not in a drastic way. Well, I can tell you they have, as you can see here, how much your Social Security becomes taxable. They're at the max. A lot of people don't know this. 85% of your Social Security benefits can become taxable. So when, as a married couple, when your income, okay, so when you're like withdrawals from your 401ks, your IRAs, plus half of your Social Security benefits, when that hits 32,000, every dollar that you go past 32,000, 50 cents on the dollar becomes income, and then it's taxed at whatever rate you're at. So I always tell people it's like a toll road. Okay, there's no toll until you hit 32,000. After 32,000, it's 50 cents a mile. Go past 44, it's 85 cents a mile, up to 85% of your benefit. So if you get 40,000 between husband and wife, what would that be? 34. They can't tax more than, they can't include as income more than 34,000. But here's the deal. So Social Security was going broke before. I think that's one of the reasons why politicians are allowing the fund to kind of get depleted, because they fixed it before at the 13th hour. It was 1983. It was running out of money. Had about a year left. And one of the things they talked about, well, why don't we just lower people's benefits? But you can imagine how hard that is, right? And so the thing that they did instead is they made Social Security taxable. And then they added a little trick. They said this will only affect, I'm kind of paraphrasing. They didn't really use the term one percenters, but that's really what they did. They said this will only affect the one percenters, the wealthy. They can pay their fair share. Here was the trick they played on you. They didn't index this to inflation. So this formula right here is almost 40 years old. It affected very few people when they started it, but now it affects a lot. And it's an effective, they couldn't reduce your Social Security, so what they do instead? They taxed it, which is a reduction. So what do we do for the Jones? Number one of the things that we can look at is cutting their 401k contributions, okay? Putting it down to the minimum to hit the match. In their case, in this scenario, though, there is no match. So just what if we got rid of the whole thing, okay? Well, that's $10,000 that they've been putting in. Well, they're going to owe tax on it now, as you can see. So we'd have about $7,000 after that. And we could put that into something tax-free. We'll talk about that. Another thing, though, here, so we've got $7,000 from minimizing or reducing their 401k contributions, but there's a little known tool. So this is awesome. Somebody in your 40s, great tool. Love this. It's called a 72T. What a 72T does, it allows you to take distributions from an IRA without penalty before 59 and a half. How cool is that? Well, we don't want you to take it out and spend it. That's probably not going to be a good thing. How many jet skis do you need? You don't need an 85-inch screen plasma TV. But instead, what if we took that out? So that way we kind of maintain the balance in the IRA. So if we take out 5%, and the IRS gives us, actually tells us, they give us a formula, a calculator on how much you have to take out each year. But what if it worked out? Imagine this, that it works out that it's basically just the interest. So the account kind of gets frozen in time at 500 grand. Well, that means if we were taking out 5% a year, there'd be 25 grand there, less the tax. That brings us 17.5. We've got almost 25,000 though a year now without reducing their disposable income, without having them invest more that we can reallocate. And we could use one of the things we could do is put it into a Roth IRA. But there are rules and we're running out of time. These are simple rules though. If you have too much income, you can't put into a Roth. There's ways around it. We can do what's called a back door. They talked about closing that. That's where you do a non-deductible traditional IRA and you convert it the next day. That's really something. Get some help on though. Just we'll leave it at that. There's advisors there's advisors out there. You don't necessarily need an investment advisor like myself on that. It doesn't make sense probably if that's all you want help on. But there are advisors that charge an hourly fee. Just make sure they're not one like me that tells stories. You don't want to pay an hourly fee to a guy that's going to tell you stories, because I'd be sitting there going, darn it, that's a $40 story. Another tool is permanent life insurance. And this one always has a negative connotation anytime we put it on the screen. Understand, though, most of our clients are coming to us in the 60s, late 50s, 60s, 70s. We generally aren't adding permanent life insurance. I still believe that if, permanent life insurance, you need to have the need for the death benefit. So we might use it more of an estate planning tool to offset a taxable liability, as an example, or to lower the amount of qualified dollars. There's some specific strategies you can use. But one of the things is if you're sitting here and you've got one of these policies, instead of getting rid of it, maybe it's a good thing to use, because you can take off a lot of these policies tax-free loans without worrying about the thing going away. So there is ways to take an income from it tax-free. Plus, as you can see at the bottom, long-term care protection. A lot of them have long-term care kind of qualities to them now. One of the things with the 72T, though, going back to that systematic withdrawal that doesn't have the 10% penalty, is that you can use that to convert a traditional IRA to a Roth. So suddenly, if you see here, so we've got the 25,000, 24.5, that was the reducing the 401k contribution. That was the 72T distribution. Now, if we put 6,500 in for husband and wife to go into a Roth IRA, we still got 11.5 to work with. Well, what if we converted IRA dollars? Well, we got to pay the tax. So if we're in a 30% tax bracket, that 11.5 could actually pay the tax on $38,000 a year. So over the course of 10 years, as an example, we can convert $380,000 worth of it. So we're systematically moving. Oh, and then the last piece here is maybe reduce the amount of cash. From a behavioral perspective, though, there's a few concerns there and things we look at. Is if we lower what you have in cash, does it lower your comfort level? And interestingly, that can be good, because if we lower what you have in cash and it reduces your comfort level. It gives you less confidence. People tend to consume. They buy less stuff when they're less comfortable. Consequently, though, is that what if it reduces your comfort level? It may make you more knee-jerk, which means by not having that cushion, that buffer, you may be less risk adverse. So by taking away the safety blanket, you may become less risk. Your risk appetite on the other assets may get diminished, and meaning you're less likely to stay the course during a dip in that other 500,000. So we can actually have a negative effect if we invest more dollars than you're comfortable with, even though mathematically it's right. But we got to be cognizant of that. We got to be aware of that. There's not a lot of behavioral advisors in the state. And I think that's important to find one anytime you're looking at doing something like this, because the mathematical right answer may not be the behavioral right answer. Mathematically, this is 100% right. Behaviorally, though, if by taking 48,000, or I'm sorry, 52, we're assuming here, divide that by 6, we're assuming that this couple spends $8,000 a month. So if we invest this 52,000 and suddenly you don't feel as good about your financial situation, and now on the money, that IRA, all of a sudden we have a dip in the market goes down 15%. What if you panic? Now, you wouldn't have panicked before because you were comfortable. You felt safe because you had the 100 grand socked away. Now you don't feel safe, which makes you more susceptible to risk, which makes you more susceptible to making poor decisions if we have negative market conditions. Number 5 is that we probably don't want to convert all of your dollars from an IRA. This is oftentimes people want to get rid of all their IRA dollars. Bad idea. There's 2 reasons. Number 1, we can take dollars out of the IRA during retirement and use that standard deduction. Standard deduction right now for a married couple over 65, so it's $27,000. In other words, you can take $27,000 out of your IRA and use the standard deduction. Now, by the way, hidden point, if you're listening, is that 100% correct? Always? Well, maybe not. It depends on what your Social Security is. If you get $40,000 in Social Security, half of that's 20. You take out 27,000 from the IRA. I'm at 47. What does that mean? Some of your benefits are being taxed. That's going to be an approximation. I'm doing off the head right now. About $5,000 worth of Social Security benefits would be taxed, roughly speaking. So you take out 27, you got 5, you actually got 32 minus the 20. You still got about $5,000 taxable income. It's in the 10% bracket. It's a $500 tax bill, not that big of a deal. But it's not just easy math like we have here. I want to, caution people on that. And by keeping their IRA to 500,000, though, your required minimum distributions at age 72 will be less. So that's cool. So there's a lot of moving parts here. Hopefully, is what you're seeing. A lot of moving parts. Can you do it on your own? Sure, you can learn this on your own. Read a bunch of books. Do I recommend everyone does it on their own? Yeah. You can be passionate about it. If you're passionate about it, you love this stuff, do it on your own. Get an hourly advisor, somebody who's going to charge you an hourly fee. Don't use somebody like myself who charges a percentage. It's not worth it. It doesn't make sense. But if you're not passionate about it, you're not going to dig into this thing, and you're not willing to accept that you will make some mistakes, get somebody to help you then. So look at the cash flow. Again, we got 7,000 from reducing the 401k. We got the 17 from the excess with the 72T. 52,000 if we were to reserve that excess cash, and $10,000 for the long-term care. The long-term care premiums, the term life premiums, those could be reallocated. And that's a big one that we do a lot. Big specialty of ours. Because here's the deal. Long-term care is what? It's a form of health insurance. And so, and it's there to protect 2 things. Choice of where you go or your assets. That's it, right? That's what it's there for. So it's going to pay for the nursing home or somebody to come in the home and preserve your assets. I get to pick where I go, and I don't spend my own money because I had insurance. Makes sense? Well, if you put this money in retirement so that you could use it, which is why you probably put it there, then over time, even if you don't spend more than the interest, over time, the purchasing power due to inflation, I didn't do that well with the camera, but over time, you're actually having a decreased value. Even if you just, 500,000 today isn't worth the same as it is in 30 years. Does that make sense? But long-term care insurance is a form of health insurance. Can you tell me one single type of health insurance you've ever seen that doesn't go up in price over time? So there's the problem with traditional long-term care insurance. It's an increasing premium on a decreasing asset. And that's if you don't touch the principal. Most people will touch principal. Then it's an increasing premium on a really decreasing asset. Got to be careful there. Make sure it makes sense. Oftentimes it doesn't. There's better ways to plan for it. Tax-free retirement changes. So here's what we did. Withdrawals from the 401k will be taxed less than the deductions or exemptions, or mostly. You can choose to make it fully tax-free. I oftentimes would like to see somebody use the 10% tax bracket. We got to guide a lot of our clients that, yes, we can take tax-free income. Here's how much we took tax-free. Maybe we should take some at a small tax amount. Lock in a low tax rate. Annual income for the life insurance or Roth is tax-free. And cool point that I forgot, income from the Roth IRA does not affect the taxation of your Social Security benefits. Interestingly enough, income from a municipal bond, which people often tell me, Mike, municipal bonds are tax-free. No, they are not. They are tax exempt. And so you go, that's the same thing, Mike. Come on. No, it's not. Tax exempt income affects the taxation of your Social Security benefits. Tax-free income does not. So loans from life insurance or distributions from a Roth IRA come out as tax-free, and that reduces the taxation of your Social Security benefits. Maybe makes them completely tax-free. The point here is you got to have buckets. You probably heard advisors use this term, buckets, and we've used it so many times. But the idea is I want to have some tax-free dollars. I want to have some tax now dollars. I want to have some tax deferred dollars. I want to have a bunch of tools in my belt. So that way, if I got to nail it, if I got a nail that needs to be hit, I got a hammer. But I don't want to sit there with the back end of a screwdriver trying to pound a nail into a deck. Likewise, I always like to joke, these advisors that are insurance only or they're securities only, and then they of course think all the other tools that they're not licensed for are bad. I had a debate one time with an advisor on that. He was telling me a particular type of planning and product was bad. These things never work, Mike. And I go, you know what? I'm done. And he goes, what? I go, I got to go home. I got to redo the drywall in my basement. He goes, what's wrong with the drywall in your basement? I go, I pounded in all those drywall screws. My drywall looks like crud. I go, I got holes all over the place. He goes, why would you use a hammer on screws? I go, that's exactly my point. He didn't get it. The client was just laughing. I go, but if you use the wrong tool for the right tool for the wrong job. So we want a lot of tools, a lot of options. So I want to have some taxable things. I want to have some tax deferred things. That's important. So give us, the last part here. Maybe you're watching this. We're going to put this up on YouTube. Maybe you're watching live. Maybe it's a friend that you want to do this. Who are we a good fit for? We're a good fit for if you want a tax-free retirement or you want to minimize your taxes. You want to have a tax strategy. We're going to evaluate that. And sometimes one of the most frustrating things can be sometimes what you're already doing is the right way to do it. I have that conversation every week where we go, this is, I don't know what taxes are going to be. If we want to assume they're going to be sky high, all right, let's do it. But you're already using a good strategy. And if that's you and we talk, I'm going to tell you that. I'm a fiduciary. I'm acting in your best interest. We've gone over these 5 steps. Categorize your money. That's one of the first things we do. Let's see what kind of tax impact you have. It's better to know. Is it tax now, tax later, tax never? You got to think about these things. Start developing a plan. Determine your tax bracket capacity. This sounds intimidating. It's not. This is a form of software. And as an example, with our Jones couple, they've got $52,000 left. You can see this yellow highlighted area. It means they've got $52,000 of income left before they go in the next tax bracket. Now, the next tax bracket goes from 22 to 24, so not horrendous. What I see is a lot of people in the 12% tax bracket, especially retirees. And they want to talk about converting $40,000 from an IRA to a Roth. Well, it'll bump them into the 22% bracket. We want to avoid that 22% bracket. And if you're in the 22, you want to avoid the 24. You certainly want to avoid the 32. So we want to avoid big jumps. And software like this tells a planner like myself, okay, if you're in the 22% tax bracket today and you're always going to be in that bracket, we've got about $52,000 of income we can recognize. Because when we stop putting the money in the 401k, we're recognizing income. When we take this 72T distribution, we're recognizing income. We got to be careful. We got to know the math. We got to do planning to make sure you don't pay taxes you wouldn't have otherwise paid. Number 3, you can calculate, here's this 72T, the equal and substantial payments. There's calculators online that you can use. Definitely don't recommend doing it long form. Use the calculators. Get a good calculator. You can find them even on the IRS website. Know your eligibility for Roth. We're out of time, so these are easy to look up. I mean, you can literally probably just Google, do I qualify for a Roth? Or what are the Roth IRA qualifications? Okay. Or find an advisor. We can help. Most important, number 5, have a plan. So you're looking at this. Is systematic Roth conversion, is that the right plan for you? Is annual Roth funding? Maybe that's the plan. Do I switch to a Roth 401k? Like in our company, our employees have a choice. Do you want traditional 401k? Do you want a Roth 401k? And we make that determination for each differently. Well, not differently, but specifically, individually, maybe. Do we cap your deductible contributions? Like that 20, the 26,000, right? Do we take out enough to do that, or do we go past it? Do you take 72T withdrawals? Do you fund a life insurance policy? Do you buy a life insurance policy? Do you keep a life insurance policy? Do you buy a life insurance policy, just pay for the taxes the kids will have? Those are conversations we have. So maybe one of these is the right fit, maybe two. Maybe it's a combination. Quite frankly, I can think of somebody right now where we've got a combination of almost all of these. But we've got to find somebody that this is a passion. Traditional financial planning, they just want to talk about rate of return. Well, what good is it, in my book that I wrote a couple years ago, and we'll give that out, I've got an offer for you guys today. But I wrote this about 5 years ago, and one of the things I said is I had found, again, I'm a behavioral advisor. I asked this question of a lot of clients. I said, would you rather make $1,000 return, or would you rather have $1,000 tax savings? Would you rather get an extra growth of $1,000 or save $1,000? Almost everyone that I asked that question to, they default to, maybe you're different, but here's what most people answer. They want to get the $1,000 return. They're like, yeah, return on their money, right? Gain. That's more fun. Most do not. The few, the small minority say they want $1,000 tax savings. I thought that was wrong. It is wrong. When it comes to growth, here's the deal. It's what I call I hope so. I hope if I do X, Y, and Z, I'll get $1,000 return. But taxes are I know so. I know if I do X, Y, and Z, I get the money. And by the way, if you get $1,000 gain on investment, how much of it do you get to keep? If it's not tax-free, you get to keep that minus the tax. Whereas on a return, you get to keep the whole thing. I keep saying return, refund. Devil's in the details. Got to go through this. So thank you all. It's been a pleasure. I know we were over in time. Hard to go through this much stuff in a half hour. I did my best. I had one more speed I could have talked at, and I don't think I think it was a good thing I didn't accelerate to the max capacity. They like to joke that I can speak like 500 words a minute with gusts at 1,200. So I didn't quite go that fast. But who needs our help? Who should call, right? Let's have a 15-minute conversation. Well, if you've worked for several companies over your career, you got a 401k here, a 403b there, and here a 4, here, there a 4, everywhere a 4, give us a call. Let's start looking at it. Let's start putting it together so you can see the big picture. What if you don't have a pension, but you have a 401k? You might outlive that money. That risk is real. Let's talk. You're worried about it. Don't have a plan. I found that, by the way, when you have a plan, you're far less worried about outliving your money because you know what it looks like. And by the way, having a plan this is not a plan. When an advisor just says, well, when you make 10% a year, right, here's the returns. And if you have these returns, you have enough money. No, wait. Pause the truck there, buddy. What if I don't get that kind of return? I saw one a year ago. Here's what the advisor showed the client as the worst case scenario. This is the worst you'd ever see. They lost 30% in year one. Ooh, that's not good. And 8% compounded growth for the rest of their life. I go, dude, I'll take that. Give me the worst case. I'll take 30 off the top, and you're going to guarantee 8 from here on out for the next 50 years? Sign me up. How's that the worst case scenario? That's not even close to historical averages. So be careful what somebody's calling a plan. Should you do this yourself? Again, I think this goes down to behavioral. Is it your passion? Do you love it? Do you love digging into it? If so, you can do it. If not, don't do it. We are offering, one of the things, part of the idea of these webinars is to try to kind of unveil, show some behind the scenes for everyone, give you guys some ideas, teach share this knowledge one to many rather than one-on-one, one to many. But we do have a couple spots each week blocked off, complimentary 15-minute conversation. I'll ask you a couple questions, see if this is for you. If it's not, it's not. That's okay. But hey, we'll have a cup of coffee. We'll have a quick conversation, and we'll see if this is some stuff that would make sense for you. If not, we'll go our separate ways. No big deal. We can talk about other strategies as well. But the process from here looks like there's going to be a link. You can click on that link. I don't know what time slots are open. If none of them work, if they're all full, because I know that's happened, call the office. We'll try to make something work, but really we're just looking at a 15-minute phone call, discussing what strategies might work and giving you a couple questions. You can see right down here, here's a link. I thought there was a link for appointments, but on that website, there's some link for the appointments. And anyone who wants it, all you got to do, just send us an email. Go on the website on the contact form. Sorry, I don't have something you can click, but if you want to copy my book, Fireproof Your Retirement, it's on me. You can buy it on Amazon. I think Amazon's discounted it now to like the seller price, like $4.95 or something. But I'd be happy to. We've got some at the office. Just call the office or go onto our website on the contact form. All you got to do is put book, and put your address. We're not going to bug you. I'm not going to send you direct mail pieces like anyone would get those anyway these days. So best way, I see a question in here, best way to get a hold of us, go to www.legacyfinancialnetwork.com. It's legacyfinancialnetwork.com, all one word. Office number is 616-589-4004. It's 589-4004. Just give us a shout. You want to have that 15-minute conversation. Awesome. You just want the book? It's on me. I'll send it. We just got to know where to send it to and who. So again, thank you all for joining us. It's always a pleasure. I love being here. It's fun. Hopefully you guys have as much fun as I do. God bless.